Assalamualaikum and good morning everyone. Thank you for being here today. We from Group 6 will present to you guys Chapter 6 in this chapter about monetary theory and policy. I would like to introduce my team members. Maziah Ahmad. She will discuss about monetary policy objective. And my second group members, Fandee. He will explain about the monetary policy in simulating economic growth, and myself will talk about advantage and disadvantage of monetary policy instrument.
Okay, for the first presenter, I will present about monetary policy objective. Okay, what is monetary policy? Okay, for the first, monetary policy is the central bank's actions and communication that manage the money supply. Second, the money supply includes form of credit, cash, checks, and money market mutual funds. Okay, monetary policy is concerned with the changes in the supply of money and credit. It refers to the policy measure undertaken by the government or the central bank to influence the availability, cost, and use of money and credit with the help of monetary technique to achieve specific objective. Okay, we will proceed to objective of monetary policy. Okay, here I put 4 objectives of monetary policy. For the first is price stability. Second is unemployment. Third, interest rate stability. And the last one is currency exchange rate. Okay, we will go one by one. Okay, for the first one is price stability. It implies avoiding prolonged inflation and deflation. Price stability is an important precondition for business certainty and the sustainable growth of an economy. It supports investment and employment while also increasing economic welfare. For the second, unemployment. Monetary policy can influence the level of unemployment in the economy. For example, an expansionary monetary policy generally decreases unemployment because the higher money supply stimulates business activities and lead to the expansion of the job market. The third, interest rate stability. A central bank can influence interest rate by changing the discount rate. The discount rate, which is base rate, is an interest rate charged by a central bank to bank for short-term loans. For example, if a central bank increases the discount rate, the cost of borrowing for the bank increase. Subsequently, the bank will increase the interest rate they charge their customer. Thus, the cost of borrowing in the economy will increase and the money supply will decrease. For the last one, for monetary policy objective is currency exchange rate. Using its fiscal authority, a central bank can regulate the exchange rate between domestic and foreign currency. Okay, for the example, the central bank may increase the money supply by issuing more currency. In such a case, the domestic currency becomes cheaper relative to its foreign counterpart. Okay, that's all from me. I will pass to the next presenter. Thank you.
Advantage and disadvantage monetary policy. Monetary policy involves the management of the money supply and interest rate by central bank, which in Malaysia is Bank Negara Malaysia. To simulate a faltering economy, Bank Negara Malaysia will cut interest rate, making it less expensive to borrow while increasing the money supply. If the economy is growing too rapidly, The Bank Negara Malaysia can implement a tight monetary policy by raising interest rate and removing money from circulation. There are many advantages of these monetary policy tools, such as: first, interest rate targeting control inflation. A small amount of inflation is healthy for a growing economy as it encourages investment in the future and allow workers to expect high salary. Inflation occurs when the general price level of all goods and services in the economy increase. By raising the target interest rate, investment become more expensive and work to slow economic growth a bit. Second advantage can be implemented fairly easily. Bank Negara Malaysia can act quickly to use monetary policy tools. Often, just signaling their intention to the market can yield results. Third, central banks are independent and politically neutral. Even if monetary policy action is unpopular, it can be undertaken before or during election without the fear of political repercussion. Last but not least, weakening the currency can boost export. Increasing the money supply or lowering interest rate tend to devalue the local currency. A weaker currency on world markets can serve to boost export as the products are effectively less expensive for foreigners to purchase. The opposite effect will happen for companies that are mainly importers, hurting their bottom line. Besides advantage, let's we talk about disadvantage of the monetary policy. 1. Effect have a time lag. Even if implemented quickly, the macro effect of monetary policy generally occur after some time has passed. The effect of economy may take a month or even year to materialize. Some economists believe money is merely a veil, and while serving to stimulate an economy in the short run, it has no long-term effect except for raising the general level of price without boost real economic output. Second, technical limitation. Interest rate can only be lowered nominally to 0%, which limit the bank use of these policy tools when interest rates are already low. Keeping rate very low for period of time can lead to the liquidity trap. This tends to make monetary policy tools more effective during economic explosion than recession. Some European central banks have recently experimented with a negative interest rate policy, but the result won't be known for some time to come. Third is monetary tools are general and affect the entire country. Monetary policy tools such as interest rate level have an economy-wide impact and do not account for the fact some areas in the country might not need the stimulus, while states with the high unemployment might need the stimulus more. It is also general in the sense of that monetary tools can be directed to solve a specific problem or boost a specific industry or region. My last disadvantage of monetary policy is the risk of hyperinflation. When interest rates are set too low, overborrowing and artificially cheap rate can occur. This can then cause a speculative bubble, whereby price increase too quickly and abusing high level. Adding more money to economy can also run the risk of causing out of control inflation due to the premise of supply and demand. If more money is available in circulation, the value of each unit of money will decrease give an unchanged level of demand, making things price is in that money nominally more expensive.
Assalamualaikum everyone. I'm Fandee. I would like to talk today about the monetary policy in stimulating economic growth. There are two types of monetary policy. Number one, contraction or inflation. Tools used will reduce money supply in the economy. This is aimed at reducing the pressures of inflation in an economy. Number two, expansionary or recession. Tool use will increase money supply and activities in an economy. This will help increase employment and growth. General monetary policies, quantitative instruments. Number one, discounts rate. This refers to the discounts rates of exchange and treasury bills. A contractionary money policy will force BNM, Bank Negara Malaysia, to increase its bank's rates. Higher rates will discourage borrowings and spending. Number two, open markets operations. Bank Negara Malaysia buys or sells securities and treasury bills in the open market to influence the size of bank deposits. Money supply in the economy can be reduced by selling more T-bills during inflation. Number three, legal reserve requirements. Bank Negara Malaysia may increase cash, liquidity or reserve ratio requirements to influence credit creation and money supply. Higher ratio will mean less amount to be loaned out to public. Number four, funding. This refers to the conversion of short-term loans to long-term loans. Short-term assets like treasury bills are reduced and more long-term loans and advances are given. This will lengthen the payments of the principal sum so that the bank cannot create multiple credits. General monetary policies, qualitative instruments. Number one, selective credit control. This is done by allowing loans for productive purposes only, by increasing minimum margin requirement to open a letter of credit, or by imposing tighter hire purchase regulations by fixing minimum down payment and maximum repayment period. Number two, moral suasion. Moral suasion. Here, commercial banks are persuaded to restrict lending policies. Number three, special directive. Commercial banks are sometimes required by Bank Negara Malaysia to reduce the volumes of loans given to public. Number four, interest rate. Banks will be persuaded to increase their interest rates on deposits to attract more savings from the public. Monetary policy for inflation. What should government do? The government may use monetary instruments or tools to restrict money supply and credit creation in the economy in the effort to combat inflation. The policy involves contractionary monetary policy, aiming at reducing money supply. Monetary policy for recession. The government and the central bank may increase money supply and credit creation using monetary tools. An injection of money circulated in the economy will induce more businesses, activities and increase employment. This also refers to the expansionary monetary policy. Monetary tools used allow the amounts of money available in the commercial banks to increase. This increases the ability of banks to loan out money, making it possible for consumers and firms to meet their demand for goods and services. Increase in aggregate demand in the economy means a rise in employment. However, the control of money supply is a short-term measure to reduce unemployment, particularly cyclical unemployment. In the long run, a continuous increase in money supply may lead to inflation problem.